Hey guys, this is Max Convexity. Thank you for tuning back into my channel. I wanted to do something on the Hive and the R Hive. The Hive is my own volatility metric. It stands for High Yield Volatility Equation. But I didn't reinvent the wheel or anything. I'm using standard IV figures that anyone can get anywhere to look at the implied volatility of a stock. And so all the inputs in this are publicly available, and this is not a very sophisticated indicator, but I think it's a pretty effective indicator. I introduced it about a month ago, and there was a little bit of interest in it. But then I kind of lost interest in it myself because the numbers didn't change all that fast. So yesterday we got all new yield max yields out. So one of the inputs is the yield of the fund. And of course that changes once a month. And so now we have some good changes and something to look at. I think I'm going to start updating this about once a week because it doesn't change that often. But it is pretty interesting. Okay, I want to explain the methodology of it and what I was thinking when I made it. Okay, my main theory is, and it's not just my theory, a lot of people think this, the market is efficient and the professional participants in the market are very skilled and accurate at judging risk. They're more skilled than the public participants, people like you and me. So the theory is if the market makers have an option priced super high, maybe they know something about the stock, or it's in other words, it's an accurate indication of the future volatility of the stock. So I took that and I started looking at the yield max funds that have options on them, because that's how it's easiest to measure volatility in a stock or an ETF is by looking at the option tables. The option market makers are sharp. They know everything, or they have the best models and the best computers. And that's also why they have the biggest houses in Scottsdale and wherever they live in Chicago, up in Winnetka, up on the lake somewhere. Who knows? They do this for a living and they're very professional at it. Ken Griffin, the biggest market maker in the world. Have you seen the place he's building in West Palm? Oh my Lord. If I find a picture of it, I'll post a bit. Oh my Lord, it's incredible. Market makers make all the money. There's no doubt about that. All right, I'm going to stop fanboying on market makers now. So the theory is, let's look over here on the left side where it says November. This spreadsheet is terrible. Don't worry about the spreadsheet. I'm going to fix it, or please excuse the spreadsheet, I should say. Let's look at QQQY, and let's compare it to JEPQ. All right, and let's look at last month. These are last month's numbers. So QQQY, what I measure first to get the yield max volatility, or I get the volatility of the high yield fund. It doesn't have to be yield max, but what I do is I look at 6-month insurance. So let's look at the option tables on QQQY, and let's see what 6-month insurance cost us. All right, the way I think of insurance is what it costs to short it synthetically to short the freaking market synthetically or actually we aren't shorting the market, we're shorting QQQY. What would it cost me if I wanted to synthetically short it and therefore lock out any of my risk? What does insurance cost? To synthetically short something, you buy in at the money put and you sell in at the money call. It's called a combo or a short synthetic or lots of things. So you can look down here at the implied volatility of this position, and it's 28.7 is what they're charging for insurance on the QQQYs. 6-month insurance, that goes out till June. So then you look at the QQQs, which is their parent asset, and see how it compares to the parent asset. And the parent asset for the same trade going out to June, buying at the money put, selling at the money call, they're charging 19%. So then that's how you get those two numbers. Those two numbers make this is today. Those are today's numbers. But anyway, forget about that. Those two numbers are what computes the Hive. So if you have an asset that's a high yield asset that's super volatile, and it's way more volatile than its parent asset, that's going to be a high hive. Then in my opinion, those are the most risky. Whereas if you look down here at, say, JPEQ for comparison purposes, we'll look back at the option tables, but we'll see what JEPQ is right now. JEPQ. So their insurance going out to May is only costing 10 points. But you have to compare that to the parent company insurance, which is NDX. Parent insurance is 18. So it's less volatile than its parent asset. And its parent asset at 18, that isn't even a super high vol. So that's going to be, so in my theory, that would be a safer, or I'm not here to say if it's safe or not, but less volatile according to the way the market makers are looking at it. So that's the general methodology of it. So over here last month, the most volatile asset was QQQY, according to this metric. So then what I do is I just take that and divide by the yield, and I get a risk adjusted in our hive. So let's look at what happened last month. Let's see what our best. All right, so last month our best reward in terms of risk was JEPI and JEPQ, but then TSLY was right behind it. TSLY has a parent vol, or a vol of itself is 47, and its parent vol is 48. So it's not super volatile compared to its parent company, but at 48, its parent company is still pretty volatile. So that's why it gets a hive of 46. All right, but when you compute 46 and then you factor in that it paid 61% last month, well, you know, it's still a pretty good risk-adjusted reward. So last month our stars were JEPY, JEPQ, TSLY, JEPY. The reason Coney's not on here and some of the other ones are not on here is because Coney doesn't have options yet. As soon as they have options, I'll put this on here. I also looked at putting FEPI and some of the other ones on here, but they don't have options either. So now let's go forward to this month. Sorry about that. All right, so now we're going forward to this month. And this month, let's see how this month compares to last month is what we'll do. We'll see which ones are more volatile and which ones are less volatile. Okay, JEPY's still number 1 on our list. JEPQ is still number 2 on our list, and Tesla is still number 3 on our list. Now, after that, it switches because last month, JEPY was number 4, and this month, it's dropped down a little bit. I look at any of the numbers above 1 as decent risk-adjusted reward. So the ones that are really problems is like, look at like OARC. OARC has its own volatility is 43. That's pretty expensive. That's the second most volatile one on the board. And not only that, so, you know, Tesla's is 44, so that's about the same. But Tesla's is not much more volatile than its parent asset, where OARC's is more so volatile than its parent asset. So that's why it got a 48 on the hive, where Tesla only got a 42. I hope this isn't too convoluted. I hope you guys get something out of this. So basically, the bad ones are OARC, AMZY, APLY, and InFlight. Now also, this is one metric. This is one way of looking at it. This hasn't been back tested. Something I like to look at, and it's helped me figure out things in my own head, but this is basically for research only. You know, big disclaimer on it, but I thought I'd share it with everyone, and I was hoping you guys might get a little something out of it, or maybe what'll probably happen is one of you guys will write to me with a suggestion or an improvement. So I'm learning a lot from you guys, and I appreciate it. I really do appreciate you guys. All right, so also I was going to just say real quick, it's a 3 out of 3 winner on the Defiant stocks. NASDAQ is up. They're all up. I could show you the charts. It doesn't even matter. They're all up. They're all way above their profit box. So 3 for 3 on max value. Or on max profit. I'll return later with an exact to the penny count on how we did. But for now, I just wanted to bring you those hive and R hive numbers and see if anyone had any questions or see if they helped anyone. But it really doesn't tell us much we don't already know, because after my video last night where I finally decided in my own brain that JEPI and JEPQ are probably the safest ones. This is a mathematical representation of that. Like I say, and it's just one measure of, it's just one way to look at it. There's jillions of other ways to look at it. So big grain of salt at all times. Thank you so much for watching and listening, and I appreciate all of you guys, and I will be back later with the evening update. Thank you so much.